Hello and welcome. We're at the Private Banking Congress in Hamburg today. With us is Ben Wallace, fund manager of the Janus Henderson Absolute Return Fund. Ben, welcome. What makes an absolute return strategy with long-short equities attractive in the current environment?
So I think at present it is actually a really good environment for absolute return funds to be making money. And I think that for a couple of reasons. Firstly, we're seeing a lot of stock dispersion. And as kind of bottom-up stock pickers, we like that because it's about business model, valuation, and the fundamentals are really working. So that bit's attractive. I think the other thing that's great though is that there's a lot of volatility, whether it's economic, geopolitical, and that volatility is also throwing up lots of potential shorter-term opportunities. So I think that environment of stock dispersion combined with volatility gives absolute return funds, especially those that have got both a long-term core fundamental book and a shorter-term, more tactical book, lots of opportunities to generate returns.
And in what ways does your fund differ from your competitors' products?
Yeah, so I think probably the things that we can point to is, first of all, we've been doing it a long time. We founded the strategy 22 years ago, so we've been through lots of different market cycles, whether it's the GFC, COVID, the list goes on, but we've sort of survived the test of time and proved we can make money in lots of different environments. I do also think the other thing that helps is having both that core long-term fundamental book that I referred to, that shorter-term, more tactical book, and also having flexibility in net exposure. You tend to find a lot of funds are either always bullish or always bearish, and for me, the world's always changing, so you've got to adjust your portfolio to cope with the events that are going on in the world.
You manage nearly 1.5 billion euros, roundabout. In which way do you structure your portfolio to achieve your goals?
Sure. I mean, for me, there's no fixed rule because the world is always changing. But the way I always think about it is I'm always looking forward 12 months and trying to achieve high single-digit returns regardless of what's happening in the world. So let's say I think the world is getting worse and equity valuations are elevated and we're finding lots of sell ideas. You'd likely see the net of the fund dropping, maybe even heading net short. Equally, if we were in an aggressive rate cutting cycle, equity valuations were low, fiscal stimulus was emerging in parts of the world, you might well see the portfolio tilted to more cyclical areas or areas that would benefit from that economic boom. So it really depends on where we are in the economic and stock market cycle.
Mm-hmm. And which instruments do you use to stop losses?
Sure. So I always think not losing money is one of the key bits of absolute return. So we've got a couple of kind of mechanisms in place to, at the very least, limit losses. First thing we do is, on the tactical book, as I said, that shorter term book, we do use stop losses. So we use stop losses of 10% from cost, which again means if things aren't working, the fund is naturally delevering and limiting its losses. The other thing where we spend a lot of time is understanding portfolio construction, because the great thing with absolute return funds is you've got all the tools to make money in lots of different market conditions, but the fact that you can be short, the fact that you can use leverage is a great asset, but it's also something you've got to be careful of. So we're very conscious of portfolio construction is crucial as well.
Mm-hmm. And on the other hand, which instruments do you use to capture the opportunities in the stock markets?
Yeah, I mean, for me, it's all about bottom-up analysis. As I said, there's periods in time when there's lots of cheap stocks, lots of great opportunities, and I would hope that we can evidence over those 22 years that we can kind of capture those. But for me, what's really the key to making money all the time? Like, what really environment do we look for? As I said, the sweet spot is stock dispersion combined with volatility, because that's going to give you the best chance to make money in lots of different segments of the fund.
Yeah, when you say bottom up, you have a special expertise in British stocks, I think. Could you outline the allocation of British stocks in your portfolio?
Yeah, sure. So to give you an idea, the overall portfolio typically tends to be invested in about 60% in London listed equities, about 20 to 30% in European large cap equities, and 10% in the US. Now, interestingly, the UK market actually doesn't have very much to do with the UK. So if I look at the FTSE 100, for example, less than 25% of the revenues come from the UK. So it's a real kind of international index, which A, I like, and B, obviously, we can be net short those stocks as well as be net long. So my view's always been, I don't care how the fund is allocated, we'll just always go to the region or the sectors or the stocks that we think are the best potential longs and shorts, then do the analysis after, just to make sure there's no unintended risks in the portfolio.
The fund is classified as an Article 8 fund in Europe. How do you exactly make sure that you don't miss ESG criteria in your fund?
It's interesting. Actually, going to Article 8 was very easy for us, because what we found is when we look back at the history of the fund, we were kind of doing ESG before ESG was the term. And it's interesting, we started out probably 20 odd years ago doing a lot of the G, the governance, and we were trying to understand, okay, is this management team, are they owners of the stock? Where are their incentive plans? Is there proper succession planning? So we were doing that. Then what we found out was on the E, if you were deemed to be a bad actor or you had liabilities, you were raising debt at a more expensive than your competition, and you weren't able to access the green bond market. So we kind of had all this criteria that we looked at even before it became ESG. So when we went through the process of being an Article 8 fund, we looked at everything we did, and we pretty quickly realized we didn't have to change anything in any of the process or anything we do, because we've been running the fund almost unintentionally as an Article 8 fund for 20 odd years anyhow.
If you allow me a last question, if you anticipate the market condition in the next 1 or 2 years, what performance and risk figures can investors expect?
Yeah. So if I look at, let's say, over the last 22 years, we annualize about 7% per annum. But what you tend to find is in environments where there's stock dispersion and volatility, we tend to run above the long-term average, as we have for the last 2.5 years. When we're in super low vol or negative interest rate environment, we tend to below the long-term average. To me, I feel like we're in an environment that's going to continue to have stock dispersion, where money's going to have a cost, and where there's going to be plenty of geopolitical volatility. So my belief, and I'm heavily invested myself in the fund, is that we should be able to do above the long-term average going forward.
Thank you very much for this great insights.
My pleasure.
And thank you very much for joining us. See you next time. Bye.